What's going on, everybody? My name is Zach Hartley and welcome back to another weekly watch list video. In this one, I want to start things off a little bit differently and tell you about a trading competition that I am signing up for. The competition has a grand prize of $10,000, a second place prize of $5,000, and they're also giving away $1,000 per week. So $21,000 altogether. The competition for trading is 6 weeks long. It's focused on Canadian ETFs, and the link is in the description to this video if you want to sign up. I have signed up for it. I am competing in it. You can see how I do. You can compete against me, and we can have a great competition that's free to sign up for, and you can win a massive grand prize. So really, really nice. Check it out. Link down below. But let's get started in the watch list here. The one thing I want to point out to start us off is the NASDAQ. And as you can see, we've got some major resistance right here around this 12,300 level. And it looks like we had just started to sort of push out of it last week. We did have a red day on Friday. It brought us pretty much back down to that exact same level. But at least we got above previous resistance. That is at least a good sign. We don't have confirmation of a breakout yet, but we have at least the starting of a good sign. When it comes to the S&P 500, we were not able to make any good progress last week. We basically traded sideways. And when it comes to the Dow Jones, it was actually a fairly poor week. We're seeing some pressure on commodities right now, and the price of commodities falling because of an expectation that economies around the world might be slowing down, particularly caused by higher interest rates. And so that is sort of the macroeconomic shifts that we are looking at in the world right now. When it comes to cryptocurrency, it was a terrible week for Bitcoin, down from about 30,000 to 27,000, so not very good there. And when it comes to gold, I've zoomed in on this a little bit. This 2,050 level is super important. That is a level of resistance that we have hit 3 times in the last 5 years. We have been falling down from that level in the beginning of May here, but we're still in this area of between 2,000 and 2,050 where we've got some major resistance, and if we can break out of that, it would be a very bullish sign. Now, when it comes to earnings this week, we've got lots of companies reporting earnings, but not any huge names. We've got Alibaba, we've got Home Depot, we got Walmart, we got Sea Limited. I like to focus on the tech stocks, and none that I'm really focused on a whole lot. I am talking about BABA today, though. I'm going to walk you through a trade that I took with Alibaba today and kind of show you what that looks like. And then FootLocker, we're also going to take a look at FootLocker. I don't like FootLocker as a company. I like it as a brand. I like it as a retailer. I don't like it as a company, and I'm going to explain why. But first, let's just have a quick chat about market conditions. Number one, inflation numbers came out last week. Inflation declined to 4.9% in April. It was at 5% in March. So it is coming down, but it is coming down very, very slowly. It is not coming down at the rates that we were hoping for and that we had expected and that we had seen over the last sort of 6 or 7 months since June of last year. But it is coming down, which is good to see. The U.S. debt ceiling is also approaching. You're going to hear more and more headlines about this. If this doesn't get solved, we could see some turbulence in the economic markets as well as the currency markets. Also, if you didn't know, one of the largest names in Wall Street is being accused of basically lying and fraudulent accounting and a bunch of other things by a company called Hindenburg Research. It is a battle of titans in Wall Street right now, and so if you're looking for a really quick swing trade based on news and catalysts, or you're looking for something exciting to read about, put your attention here because this is a wild, wild story. Also, like I mentioned before, oil is moving down as well as some other commodities, basically on an expectation that world economies might be slowing down here, and then high interest rates. We are currently in an area of high interest rates relative to where we've been at for the last 10 or 15 years. I think this is going to continue for a foreseeable future, unless we see a drastic pullback and recession in the economy, in which case the Federal Reserve might choose to lower interest rates in order to spur the economy. But without that major pullback, I do expect interest rates to remain high for the foreseeable future. Now, when it comes to stocks this week, I did make a trade in Alibaba. Like I mentioned, we've got some major support here right around $80. So I'm buying in on the bounce off of $80, looking to get up to 100 or 120. I put a $10 trailing stop loss on this. And so if it drops below, I think it was like 79.15 or something like that, then I will be out of the trade. But as of right now, we're doing okay. I'm going to give this one some patience and some time. We do have earnings coming out on Thursday, though, so that is kind of an X factor that we need to manage. But we'll see how the week starts with regards to Alibaba. Another company I want to point out to you is Albermarle. They are a lithium producer in the United States. They're the largest lithium producer in the US, and they're currently trading at a 6.3 price to earnings ratio. They are a pretty solid company. They're doing well and they're growing quickly. I like them. They're also US based, so it gives you US exposure and supply chain. Everything about the stock, when you look at their investor presentation, is good. The problem with the stock right now is that the price of lithium has fallen off a cliff from 600 Chinese yuan all the way down to 200,000 Chinese yuan. It does look like we may have hit a bottom and we're starting to recover here. But as of right now, lithium prices have been extremely volatile, at least over the last kind of 8 to 10 months here. Now, when it comes to FootLocker, I mentioned this before, I don't like FootLocker. Let me explain why. Number one, e-commerce. Once people understand what their shoe size is with a certain brand, they can usually just continue to order that shoe size. And so e-commerce is getting better and better at delivering all of the products that FootLocker is trying to sell. That is one headwind that FootLocker has. Number two here is that major brands want to sell direct to consumer. If you go anywhere in the United States, you will know that Nike usually has some stores in all of the major cities where you can shop directly at Nike. That is growing worldwide. I live in Calgary, Canada, and we never would have expected to have a Nike store, but guess what? They're opening a direct Nike store in the major mall here in my city, and I can't understand why anybody would want to buy Nikes from any of the 3 or 4 other stores in that mall when they could just go to the Nike store and get a better selection and probably a better price. And so I think FootLocker is going to struggle over the next 5 to 10 years. I plan on shorting the stock over time. I don't like the company as a business model, and the company is actually making less operating income now than they were making in the last 5 to 10 years. And so they're not growing their profit in any way. They might be growing their top line by opening new stores or having some promotions during the pandemic, but they're not making more money than they were making before. And over time, I think they're going to make less money because of these headwinds. And so that is my theory on FootLocker. If we fall below this kind of area right in here around, let's call it $37, $38, that's probably when I'm going to be looking at a short on FootLocker, but this is sort of a long-term thesis where I just don't think FootLocker is going to be here in 10 or 15 years. That's just my opinion though. Take it with a grain of salt. Last company I want to show you here is ChargePoint. This is actually a company that I started making videos about when I first started on YouTube, and the price was actually higher then than it is now, like 2 or 3 years later. And so ChargePoint has taken a major hit. They have fallen pretty drastically. They have found some major support around $8 though. And the company is growing their revenue pretty nicely quarter on quarter. They are growing fast. They have a nice revenue stream. They have a nice revenue base. I think the wind is at their back. I think they're going to do well over the long term. Now it just comes down to, can you get in at a reasonable valuation? Is $8 a good valuation? That is going to be up for you to decide. But what I'm trying to point out to you is that we've got some major technical support at $8. If you can get in on a bounce off $8, set a stop loss at $7 or $7.50 or even $7.80, you have an amazing risk to reward trade here with ChargePoint. So that's what I'm trying to tell you. And if you get any value out of this, please remember to click that like and subscribe button or check out my free stock market fundamentals course. It's hosted on Skillshare, 10 hours of content, 400 reviews for you to read through, over 14,000 students, and it'll be the best free resource that you can find online. I absolutely guarantee it. It's well worth the time, well worth the effort. Thank you guys so much for checking out this video. Remember to sign up for that trading competition. The link is down below, and I'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.